G'day. Welcome to the AgriCoach podcast for families on the land who want to grow their family's wealth and prosperity across the generations. I'm your host, Ben Law, and I'm the financial bloke. Welcome back to the AgriCoach Wealth and Wisdom podcast. I'm your host, Ben Law, also known as the financial bloke. Today, we're diving into a topic that's making waves across the farming community, not just in the UK, but potentially right here in Australia too. I want you to imagine working tirelessly to build up a legacy for your family, only to face tax legislation that when you die could put it all at risk. That's exactly what's happening in the UK, where a proposed inheritance tax on agricultural assets is threatening the future of family farms. Today, we're not just talking about the details of this tax, we're asking the tough questions. How can politicians justify prioritising massive spending on aid and immigration while imposing policies that could devastate farming families? Could this happen in Australia? And more importantly, what can you do to protect your family's legacy before it's too late? Joining me is serial guest Tim Rivett of RHR Lawyers, who's going to help us unpack what it means for farmers both in the UK and potentially here at home. We'll explore the political landscape, the economic impact, and some crucial steps farmers can take to safeguard their futures. So grab a coffee, sit back, and let's dive into this critical conversation about the future of farming and family legacies. But before we kick off, we've got to keep those pesky lawyers happy with a disclaimer. The information contained in this podcast is general in nature and for education purposes only. It's not financial advice, it's not legal advice, it's not tax advice. No one should act on the information without appropriate specific advice for your particular circumstances. I'm a former financial advisor and I choose to no longer be licensed and cannot and will not give you specific or personal advice in this podcast. Now that we've got the lawyers happy, welcome back, Tim.
Thank you, Ben. Really good to be back. Interesting times in which we live.
It is. I mean, we're back here to talk about death taxes and inheritance taxes, which for many people, they'll probably be thinking, you know what? Why are we talking about this again? And, this isn't a really big deal. Why do I want to listen to this? And we talked about this back in episode 27, which seems like a lifetime ago. And we got some really good feedback back at the time. But I know you got some feedback and mentioned, a number of people came back to you about it. What was the feedback you got after doing that one?
Yeah, we had a really strong response from lots of people, some existing clients, but lots of people who we haven't interacted with before who just reached out and said, hey, really interesting, thanks very much, particularly the older ones who touched base and said, I was around in the Sir Joe years and I remember death taxes being abolished in Queensland and everybody moving to the Gold Coast. They were interesting times. Thank goodness we've got rid of them. And the feedback I generally got from a lot of people was it won't happen again in my lifetime, which is great. We hope it won't. But it was really interesting feedback because it's not the whispering that we're getting in terms of what might be coming in the next 5 or 10 years.
Yeah, well, it's really interesting because when we talked about this just over, it would have been 18 months ago, we started talking about it, as I just had this sense that the way the political system was going here in Australia, we were seeing less and less, I don't know whether respect for farming families and the effort they put in and the fact of that we feed the world or at least feed Australia. There seemed to be this political or lack of political respect towards that. And I started to sense that we were going to see some movement in these death taxes because it was a big pot of gold. And there was part of me that went, yeah, we're going to definitely see this. This is such an obvious pot of gold that the government can tap into. But then the other part of me went, well, yeah, but nobody would be that stupid. And now we've seen a Western country like the UK in the last couple of weeks turn around and say, yep, we haven't taxed farming families from an inheritance tax point of view, but now we're going to. So now, Tim, what I want from you, mate, is can you tell us exactly what's happening in the UK, just at a high level? I don't want to tax nerd out because we'll sometimes do that, but what are the implications of this and who's it going to impact, mate?
Yeah, so the UK recently had an election. We never like to delve too far into the world of politics, Ben, but it's highly relevant for what we're talking about here. The Labor government is now in power in the UK. It was pretty much a landslide election. And what was very interesting is that a lot of rurally held seats that were part of the Conservative government changed over to Labor, which means that farmers voted for Labor. They wanted change. And one of the first things that the Labor government has done in the UK is tweaked the death tax exemptions that have been in place for a number of decades for farmers. So what this means, we've talked about the UK having death taxes. It's one of the peak jurisdictions in terms of their system. And the history we know, some families had to sell the family farm just to fund the death taxes. That's the unfortunate consequence of what was happening in the middle of last century in the UK. So there are death taxes. There are certain thresholds in the UK. So you get exemptions if you don't have a few bucks. But once you hit those exemptions, you pay 40% death taxes on the overall value of your estate above that particular threshold. So just think about that for a minute. 40% on your overall value of your estate over the threshold. The threshold's about 320-something thousand pounds. So if you've worked hard through the generations and you've got a farm worth multiple millions of pounds, you have to fund 40% of the value of your farm. There was an exemption in place, Ben, that said, look, that's not fair. We really love farmers in the UK. They feed us. They're an important export. So let's get rid of inheritance tax on farms so that we don't force these poor families to have to sell to fund their tax bill. We'll give them 100% exemption. There's no death taxes on family farming. Everyone was happy. That sat in place for a number of generations. Labor government gets in and says, you know what? The pot of gold is too big. You've had a free ride for too long. We're not that interested in food security anymore. So we're going to halve the exemption, and instead of paying 40%, you guys are going to pay 20% on every dollar that your overall wealth is worth over the £1 million mark. Okay, so think about that. £1 million, yes, it is a lot of money. There's an exchange rate issue here. If you convert it into Australian dollars, it's a lot of money. But the average price of a UK farm in acres is around £10,000 per acre. So as soon as you have 100 acres, you're in death tax territory. So this has been a really, really big, impactful policy, and it's prompted a number of communities within the UK to take to the streets. There was a blockade during the week. A lot of farmers took their tractors down to the city and blockaded Parliament House and Big Ben and, all the tourist destinations to try to express their disappointment that this was even come to the table. And the way that the Labor government is structured in the UK, they have the majority. So if they want to push it through, they'll push it through.
It's interesting, isn't it? What do you think has triggered them to actually do this now? It's never happened before. All of a sudden now it's become just something they've said, yep, we're going to do this, and to hell with the political consequences.
Yep, post-COVID debt is definitely a big one. Ben, we all know that governments during COVID to keep economies afloat during lockdowns created a lot of stimulus. So yes, that prevented recessions and depressions and all sorts of awful things that could have happened as a consequence of the global pandemic. But what that does to the balance sheets of these governments is it puts them in huge amounts of debt. So new governments come in and say, well, how are we going to get rid of that debt? You and I have talked about this, Ben. There's only two ways that a government can create money. They can tax their people or they can sell stuff. The UK doesn't have a lot left to sell as a general rule because they're a highly privatised Western economy. They've already sold the stuff. So what they look at is taxation. And probably for the same reasons that Australian farmers should be worried about this is the value of land in the UK has grown very, very steadily in excess of other asset classes. So the UK has some very valuable land. £10,000 per acre is a lot. That's not including Ireland, which has the most expensive rural farming land in the world. So the pot of gold is sitting there. And the temptation, I think, I have a theory that Brexit, which was the flashy name given to the UK leaving the European Union over the last few years, has caused a lot of rethinks in terms of taxation revenue. So these poor farmers have been hit twice. They've been hit by Brexit, and that's changed farming in terms of their export capabilities. But they've also been potentially hit by this, which I should say is not law yet. It's been announced, and now they're going through the public backlash. And like I said, farmers quite rightly are taking to the streets to express their dissatisfaction.
It's an interesting thing because you sort of talk about percentages and you say, 20%. But when you actually delve that in, if you were, say, here in Australia and you had a farm worth, let's say, $5 million, or let's say $10 million, that's $2 million your beneficiaries would have to come up with just to be able to retain that asset. And you can imagine most family businesses, let alone family farms, could turn around and stump up another $2 million just to inherit that property. So it's a fairly big deal. And I think for the vast majority of farms over there, there's absolutely zero chance that they'd ever be able to fund this across the generations. I mean, most of them, I don't know if you've watched Jeremy Clarkson in his Clarkson's Farms, which I absolutely love for a laugh, is you look at the profit they're making out of their businesses over there, it's very low. And most of them are really not, or marginal, if unprofitable. And I think it's pretty much a sign that if it comes in, most family farms will be lost, if not in the first generation, definitely the second generation. And so that changes things dramatically. For me, Tim, I also have heard, I think some of the drive behind this is, you see it here in Australia, but in the UK, you've seen a lot of really wealthy people, non-farming people. So, like Jeremy Clarkson, that's got a lot of money from non-farming areas, rock stars, business people, etc., coming into the UK and buying farmland. And they've been accused, whether this be true or not, of actually buying that land because now it's exempt from inheritance tax. So if you're a rock star and you've got £50 million, you put it into a farm or a bunch of farms and you hand that on to your kids and all of a sudden it's tax-free, that's a fairly large incentive for the people to actually do this. Now, not only is that bad for the economy because they're not picking up the taxes that they're supposed to be getting, but I think it's also bloody bad for farmers. So in many ways, I think they might be trying to address that problem. But I think there's also this underlying, as I mentioned before, real, whether the words disdain for farmers or a lack of respect for what farmers do and how hard they do what they do, and just this thought that, hey, we can just source all our food from elsewhere. These rich farmers, they've had it too good for too long, and we need to start taxing them. And I think there's a combination of those two things coming through. And Jeremy Clarkson has been probably one of the most high-profile people kicking back against this in the UK.
Yeah, it's clear that the UK government in particular has lost the love for the food security of the UK. So think back to pre-Brexit, the UK was part of the European Union. The general attitude was that the EU will feed the UK. Okay, so at the moment, the UK only produces about 60% of the overall food that it consumes. So it imports 40% of what it needs. So you think about the political and armed conflict unrest that's going on in the continent of Europe, not necessarily Western Europe, but Europe. And you think if that became escalated and even more problematic, the UK could not feed itself. So it seems like a really strange policy to me. The exemption for inheritance tax on farms was brought in because, like Australia, a farming operation tends to be asset rich and cash poor. It's a very low return. You'd actually get a better return sticking your money in a term deposit at the moment. The UK is possibly a little bit worse just because of the scarcity of their land. Some of it's very, very productive, but the average farm size is much smaller than what you would find in Australia. So you have to think, why is the UK doing this when they've just gone through Brexit? They're trying to re-establish their food security. I suppose they're just assuming that the European Union and other countries will always feed them, probably including Australia. It just seems a really, really strange policy for me to bring in, but maybe it's driven by those forces. Maybe the rock stars have ruined it for all of us, Ben.
Who knows? But we're seeing this right across the world. I mean, look at Germany. They shut down their nuclear plants and then they put themselves in a position where they're totally reliant on Russia for their gas, which is just absolutely mind-boggling that they'd actually do that. And they've put political policies in place to be able to do that. The politicians just don't seem to be able to think strategically. They think everyone's going to get along and we're going to be able to get it overseas cheaper than we can get it back home, which is a bit of a strange thing. And I think this should be a wake-up call for people here in Australia because this is a Western democracy. We don't usually see these things happen. Most Western countries have historically been intelligent enough to realise energy security, food security, medical security are really, really important for a democracy to be able to survive and thrive. And we saw when COVID happened with the medication side of things and the fuel and et cetera, Australia was in a really precarious position. So we should be looking at what's happening around the world and going, hey, it may not happen here, But hey, there's a precedent now. There's one country around the world which we have very close ties with. We're part of the Commonwealth that has now turned around and said, yep, we don't see value in farming anymore. We view farmers as just having it too easy for too long and they're not paying their share. We're going to go out there and tax them. And I think we should be remembering that the political power farmers have in here in Australia is possibly as small, if not less, than what they are in the UK.
Definitely. And remember, at the end of our episode 27 podcast, Ben, we said if something happens, you hear about something that you don't like, make noise, sit up straight and talk about it. And one good thing that's coming out of the UK is that understandably, their farmers are not taking it lying down. They're not looking at that and saying, well, that's fair enough. They're screaming, they're shouting, they're taking to the streets, they're voicing their disapproval, which is excellent. We'll have to see how that unfolds, whether that makes any difference in terms of implementation of this proposal. But for now, it's very good to see the very, very public backlash. Ben, I just wanted to make one point of clarification about how this is going to work in the UK if it becomes law. So the government came out and I think they understood there'd be some backlash associated with this and the questions around how are we going to fund it? What if we have to go and get a loan for the 40%? It'll cripple us in 2 generations of debt, all that stuff. So what they've said is in their policy, there's going to be an interest-free loan to the beneficiaries of the estate over a period of 10 years in which to pay that inheritance tax. So most UK inheritance taxes are payable within a year or two after the death of, the whoever. This is a little bit different. At least they're offering 10-year payment terms, but it's going to take most of these operations more than 10 years to pay them back. Because their return on investment is so low, they just don't produce the cash flow associated with the underlying value of their assets.
And also too, I know I think it's a 7-year rule, Tim. You can transfer assets, and please, no one should get this right. But I remember when I was over in England back 20 years ago, staying with my uncle in England, and he was saying how that over in the UK, they can transfer assets intergenerationally. He wasn't on a farm. And if it's done within 7 years of death, the government can actually claw that back. So I think that's another really important point is, people do planning over there to be able to manage the inheritance tax. But if it's within 7 years, that's when they still get hit with that. So I think that's a really important point as well.
Yeah, it is. And we have similar rules in Australia, been associated with eligibility for settling payments, pension payments. There's a carry forward 5-year rule. If you give away assets, then that's all counted towards that total for your means tests within a period of 5 years. So we've banged on about this before that, yes, there are ways to plan around this, but you can't do it when you've received a diagnosis. You've got to think about this 5 to 10 years out. There's stuff we can do, but you need time. Time is your friend with a planning exercise like this.
Absolutely. Now, this is going to be really important. We're going to have an election next year, 2025. Leading up to election, politicians make a whole lot of promises. After elections, they usually break them. And the reason is politicians are rewarded for what they say, not what they actually do. What's your thoughts around tax changes leading up to election versus post an election?
Yeah, so announcing tax changes in the lead up to an election is political suicide. Ben, history in Australia tells us that. Take the UK, for example. The Labor government did not run on a policy of reintroducing inheritance taxes for farms. Okay, you've got to understand that this was a blindsiding policy. They were saying all sorts of things to win votes, and it was very successful. And like I said before, those farming communities actually moved away from the Tories, the Conservatives, and voted for Labor. And to thank them for it, this is the first policy that they've brought in to say thanks for voting for me. So the Australian election in 2025 will be very interesting. You will not see anything written about announcements around taxation reform and the introduction of death taxes. Okay, you just won't. It will be a policy that's introduced by a government afterwards. It tends to happen in the first or second years of an elected term. That way they have time for everybody to forget about it by the time the next election comes around. So tax reform is never done at the end of terms. It's very difficult to implement. So it will be interesting to see what our political parties do in terms of the election next year. I think it's going to be a platform of energy security, renewables versus nuclear, probably a little bit of foreign policy, but probably not a lot about tax. I just don't think it's going to be an election issue. It'll be fiddled with after the election is over, and you'll start to see some policies around superannuation. One thing I do want to bring up though, Ben, is in the last episode, we talked about this other de facto inheritance tax thing in Australia within superannuation. if you remember, we talked about taxable balances within super for people who pass away. The current government brought out another great idea, which is the $3 million let's tax unrealised capital gains in people's super funds. Now, that affects a lot of rural people who got good advice back in the day to roll some of their farms or purchase some of their farms in their self-managed super funds. So I said to you in our last episode, Ben, that this was just bubbling along and people didn't really understand how important it was and what an impact it was going to have on pretty much all Australians. Why did I say that? Australians do not tax unrealised capital gains.
Can you explain what that means just for everyone listening, Tim? What taxing a capital gain means and what an unrealised gain is?
So I buy a farm for $1 million, Ben. I hold it for 10 years and I sell it for $2 million. I've made a gain of $1 million, which is the difference in the price that I paid for it and the price that I sold it for. That's called a realised capital gain because you've sold it to somebody and they've paid you $2 million. I now have $2 million in the bank and the tax man says you have realised a capital gain, so I'm going to require you to pay a portion of that $2 million in cash and give it to the Australian Taxation Office. Fine. There are exemptions available. Capital gains tax, that's how it works. Now, Australia has never had a regime about unrealised capital gains. So you need to sell something or transfer something, create what's called a disposal event to create a taxation liability. What this $3 million thing is saying is that you don't have to sell something in order to pay the capital gains tax. They're going to force everyone to go and get evidence of value on an annual basis. And if the value of that asset or the overall assets exceeds $3 million, you need to pay some tax to the Australian Taxation Office, which is the first time that any Australian government has ever thought to do that. It's a really, really silly thing to do because you haven't actually sold anything, you haven't transferred anything. There's always going to be fights about what its market value is, and you've got no cash to pay the tax bill, Ben, because you haven't sold anything. It seems like madness, right?
It does.
One good thing that's happened is that law was introduced about 18 months ago. We talked about it in our last episode. It was just cruising along. Everyone was saying, she'll be right, she'll be right. That's the Australian way. It made it through the lower house of parliament at a federal level. And then thank goodness, the Senate, which is our upper house of parliament, which is controlled by a number of independents, a number of teals at the moment, they sat up and said, is this really a good idea? We want a bit more information on what this is going to mean in a broader sense of Australian taxation reform. And at the moment, it's stalled in the Senate, okay, which is wonderful because it looks like that tax is not going to get through before the 2025 election. Okay, that's really good because once you start taxing unrealised gains, yes, it's an obscure thing. It's only in super funds worth over $3 million. But everybody who makes tax reform thinks, that's great. Australians are okay with us taxing unrealised capital gains. Let's do some more of that, Ben. Let's pull some more levers and see what other pot of gold we can get our hands on.
It's interesting, isn't it? Because whether you transferred a farm in there, it could be a commercial property, it could be shares. Like shares, it's probably a lot easier because you go, okay, my shares were worth $3 million, they're now worth $3.1 million. I can sell some shares to be able to pay that tax. I'm not suggesting this is in any way, shape or form a good policy. But if you've, say, got even a commercial premises and it's gone from $3 million to $3.5 million and you've got to pay tax on that $500,000 and you got to come up with that money, you can imagine assets are going to have to be sold just to be able to pay the tax, which is significant. And I think the point we want to make is the fact that the government's actually suggested or the government was willing to implement this. The politicians in power have created this bill. They've got advice from their tax teams, their legal teams, and they're out there putting this in front of the government and saying, this is what we want to do, which is, for me, is frightening because that, as you said, that can then be a theme throughout the rest of the economy. It becomes normalised to tax unrealised capital gains tax, which is just terrifying. I mean, imagine if it got into farming and all of a sudden your farm's worth $10 million and next year it's worth 11 and they say, yep, we need you to pay tax on that increase in capital value, even though you have not sold it. I mean, that's terribly frightening. I think the worst part, though, is it's the teals and the independents that have happened to stop this. And if they'd have gone in and gone, yep, this sounds great, this could be in legislation straight away. And then that starts to set the precedent. Now, my opinion is a lot of those teals live in inner city suburbs. So, inner Sydney and in Canberra and those sort of places. So they're looking probably at their super funds going, oh, gee, this is going to affect us. But if it transfers over into the farming world, they don't live in the farming world. So they're not going to go in and back farmers in any way, shape or form. So I believe our industry organisations need to be really, really lobbying and carefully looking at these, because they've shown their true colours, I believe, here, and they've showed their intentions that they will grab that money if they possibly can, get it through there. And if we see some sort of landslide or change in the political landscape of the next election and someone gets a greater balance of power and can get it through the two houses, who knows where we'll end up.
That's right, Ben. Think about what it means. It means that the government is saying to farmers, I don't really care what impact this has on you. I just want tax revenue. Some governments just don't understand rural enterprise. They don't understand the asset-rich, cash-poor concept. They just make assumptions that you'll find the money. But it's seasonal business, Ben. For those who rely on seasonal conditions to make money, it's extremely risky. And just because you make money one year doesn't mean it's going to happen next year.
Yeah. And I mean, if I look at the political landscape in the UK, I was watching a politician get interviewed about these changes in the UK, and the vitriol and the disdain and the way she was talking, there was two. There was a gentleman and a lady, and the way they were talking was about, farmers have hoarded wealth for way too long. These rich farmers that are hoarding the wealth that should be going to the rest of the community, why should they be treated differently? It was this absolute disdain in their voice and their rhetoric, which was quite interesting. And, you see this, and you look at the money they're going to raise in the UK. I can't remember the exact number, and maybe I'll embarrass myself here, but I think it was like $500 million a year, $500 million. And they were also talking about in the UK, they cut pensioner energy subsidies. So they were essentially helping pensioners, some of the most vulnerable in society, actually subsidise their heating in winter to be able to keep themselves warm. And that's saving them hundreds of millions of pounds a year. But then they're sending billions and billions and billions of pounds overseas to like Ukraine and other foreign aid. So there seems to be also this change in, I suppose you'd say, values systems within the system around looking after our own and supporting the people that look after us, to worrying more about their virtue signalling of where they're sending their money elsewhere. So anyone that thinks here in Australia, the politicians will worry about us. Again, we're seeing in the UK, they're not worried about us. They're worried about everyone else. So we need to stand up and watch that as well. So the other thing, Tim, is I want to go into now is, inheritance tax or death taxes is what we talked about last time. And we talked about that $3 million super tax, which is essentially a new tax that would come in. But what is going to happen here in Australia, our opinion is it won't be called a death tax. It won't be called an inheritance tax. It's probably going to be something like a change to capital gains tax. When you sell an asset is when you pay capital gains tax. But here in Australia too, is within the farming world, is you've got something like the CGT-free areas. So just talk us through that again for anyone that hasn't got to listen, about how it looks now, Tim, in very rough terms, but how it might look with just the teeniest little tweak could have a massive implication and come in as a death tax or an inheritance tax in all but name.
Yeah, the terminology, the labels are really important. Australia will not announce that it has an inheritance tax or a death tax. There will not be that terminology used except by journalists to paraphrase what these new laws might look like if they are introduced. The capital gains tax regime is complicated, Ben, which is why we always urge people to go and talk to their accountant and get really, really good taxation advice on what all this means for your personal circumstances. But we have a couple of exemptions in Australia. The most common one is the principal place of residence. So if you own your own home, you live there for the whole time and you sell it, you will pay zero capital gains tax. Okay, you'll walk away with the wholesale proceeds and buy another home or whatever it is you want to do. So
like here in Mooloolaba, we were only looking across at some houses. One sold the other day for $15 million. You could have bought it for $5 million, leave it for $15 million. It's all CGT free.
There is no upper limit on the principal place of residence exemption.
And you can see how that could be a really good pot of gold for politicians to go,
That's definitely a low-hanging fruit, particularly in the high-value property areas of Australia, some of the capital cities. Obviously, Sydney used to be Melbourne, not so much Melbourne. They've had some slides in property prices, but it's all very valuable property. It's in the millions. So yes, you can sell a Sydney Harbourside mansion for $60 million, and if it was your home and you lived there, that is completely capital gains tax-free. Now, for investment assets, we have a 50% individual exemption. So, Ben, if you and I go and buy an investment property or a farm and we hold it for more than 12 months and we sell it and make a gain, we automatically get a 50% discount. For people in rural enterprise or any enterprise, but particularly our listeners, there are other small business exemptions that can minimise your taxation on the sale or disposal of a rural asset. There are tests associated with that. So there's a turnover test. It's a $2 million turnover test. If you sneak underneath that, then you can qualify for certain exemptions. And there's an overall asset test of $6 million, which a number of families don't qualify for because the value of the underlying land has snuck up over that. So what will happen if these death taxes are introduced by any other name? It will be some changes to the capital gains tax regime to say, hang on a minute, the 50% CGT on investments is too generous. Let's make that 40% instead. And let's put an upper limit on the principal place of residence exemption so that, wealthy people who have these mega mansions and sell them for tens of millions of dollars don't get such a good deal out of it. But those policies are less likely to be implemented because there aren't that many people in Australia who have those sorts of assets and those sorts of things. So if you suffer the political impediments to getting those laws through, you're not actually going to raise a lot of money from it because your number of people who will be affected will be quite minimal. But the capital gains tax regime is certainly the low-hanging fruit, and tweaking those percentages and justifying them as something realistic and reasonable and to create fairness, and maybe there's a bit of rhetoric about redistribution of wealth, which we're seeing in the UK. That's what we're really looking out for, is the broader tax reform and what that will mean for those capital gains tax exemptions, which everybody has, yes, enjoyed. It's a good system. We're just not expecting them to last forever.
Yeah, and also too, the 15 years, you see a lot of families start talking about the 15-year rule, that these assets are held for 15 years and there's additional, I suppose you'd say, concessions if they're an active asset or a business asset.
Yeah, definitely. So again, when you delve down into the eligibility, the 2 million, the 6 million, and then what you can get within that regime, once you're in that, there are a number of things you can do. You can roll some of that gain into super, and if you're of eligible age, you can pull it straight out again. There's lots of good planning tools you can do if you get good advice, and good advice in advance of selling something. So don't go and sell something and then go to your account and do it the other way round. And one thing I would say, Ben, is that we're all busy running our businesses, right? So working in the business versus working on the business. If you don't know what your cost base of your farming assets is, cost base is an accounting concept which is used to calculate your capital gains tax. If you don't know what your cost base is today off the tip of your tongue, go and find out, because it is probably the most important piece of information that you should have access to. It's just as important to how full your trough is. It's just as important to the commodity price of whatever grains or legumes you're growing. Your taxation consequences of a transfer of land is probably the thing that's going to cost you the most money in terms of life events. So if you don't know, if you're not armed with that information, make an appointment with your accountant and go and find out. It's not always that easy, Ben, because some land is inherited, some's purchased, some's pre-CGT in 1985. It might not be the answer to the question on the day, but that's why we say to people, go and find that information, because information is power.
So if you're sitting in a farming situation and you're an intergenerational farming business, you've got significant assets tied up in it, what's some things that farmers can be doing to protect themselves, mate?
Yeah, I suppose one thing is think about succession. I know we bang on about succession and everybody's sick of hearing me talk about it.
Sorry, Tim, just to pause you on that. I think the problem with it is people get sick of hearing about it because they don't take action. But the reality is if they actually took action earlier on, prepared for succession, it would be a much better conversation to be had.
It's very true, Ben. It's exhilarating and you will learn a lot through a succession process. Yes, there's some ups and downs. Not everything goes completely smoothly, but it feels so good to have a plan, Ben, in any business. So succession is just a plan. So one thing we would say is go and start the process if you haven't already and think about what you want your life to look like. Is retirement a concept that you're comfortable with? Do you want to work until the day you leave this earth? But one of the most important things we say to people is have a plan. And if that plan involves the gifting of assets while you're alive, you will minimize the risk of any form of death tax. If you've gifted property while you're alive to the next generation, it can be a lot more tax effective than leaving it to them under your will. There are stamp duty exemptions, there are capital gains tax exemptions, there are all sorts of things you can do. You will not only minimise the chance that there may be a claim on your estate, because if you leave the farm to one child and the other children are not happy about that, all hell can break loose. If you've gifted that property to them while you're alive, then a claim can't be made on your estate because you don't own that property upon the date of your death. But if inheritance taxes are brought in, yes, we've always got the risk that they make it retrospective, like the 5 years, 7 years we've been looking at earlier, Ben, talking about earlier. But we're helping a lot of clients accelerate their succession plans. So the will says, when I pass, I give my farm to my daughter / son-in-law / son, whatever that looks like. But you know what? I'm in my 70s now. Do I really need to own this until I meet my maker in my 80s or 90s? My children are in their 50s or 60s by then. It's too bloody late. So let's bring those plans forward, make sure that the person giving the property away is financially protected. We can do that with loans and all sorts of good things. But that's a really simple way of actually thinking about how to protect you against the capital gains tax regime, because you've planned it, you've done it on a year when you've snuck under the 2 million, and maybe you're entitled to all of these great capital gains tax exemptions. And if the planning is done right, you can often pay zero capital gains tax. Worst case scenarios we tend to plan with our clients is that they have to tip a bit of money into super, and then you can pull it out as soon as you reach 60 or whatever your age of entitlement is.
It's interesting. One of the things that I'm seeing a lot of these days, mate, and this is the unintended consequences, is families have gone through a succession type process or part of a succession process about 10 to 15 years ago. So they've gone to their accountant, they've gone to their lawyers, they've sat down, they've done the plan, and then they've looked at it and they've gone, oh, gee, if we enact this now, it's going to cost us a bunch of money in well, it might be stamp duty, most likely not, but in taxes and costs. And they go, well, why don't I just wait till I die, hand the asset over, and then we won't incur those. And the point I make to most families is now they're running into problems where mum and dad have got a lot older, and that all of a sudden they're looking going, well, the farm's being transferred via the will, which was okay 15 years ago. But now there's been some ill will come into the family, and there's a chance it might get challenged. The second thing could be, well, we're going to leave mum and dad's super to one child, which was worth a couple of $1 million or $1 million, and then the farm to the other child, and that farm then was worth $5 million. So there was a bit of a disparity, but everyone was happy. Now that farm's worth $15 million, and the super's now worth $2 million still. And then all of a sudden someone goes, well, I know we agreed to this 15 years ago, but screw you, I now want more. And then it turns into a family dust-up. And then the third one is we're seeing is people going, oh, we didn't make any changes back then because it was going to cost us $100,000 in capital gains tax or $200,000 in capital gains tax. That's just ridiculous. Now they're looking at capital gains tax liabilities in the millions, or they're looking at millions of dollars being lost in legal dust-ups when someone dies for an estate being challenged. So I think the really important thing I'd want to say to people is, number one, surround yourself with a really good board of strategic advice, your lawyer, your accountant, your financial advisor, your bank manager, and actually work this stuff out. As much as you may not want to, it's technical, it might cost you money, is work this out early and put something in place that gives you far more certainty. Don't kick the can down the road. And the second thing is sometimes protecting your assets or protecting your family relationships, because I think that's probably the most important part, is get this right and it's not going to break down family relationships. Yeah, it might cost you a bunch of money, but it's going to cost you far less than potentially 10, 15 years down the track, because your tax liability never shrinks, does it, Tim? If you've got a $200,000 capital gains tax liability now, in 15 years' time, if everything's gone ahead, it's going to be substantially more. So take action early on.
Exactly right, Ben. History tells us that land does not get cheaper in Australia. I know none of us have a crystal ball. We don't know what's going to happen, but they're not making any more rural land And for environmental policy reasons, it's getting a lot harder to improve the productivity of land. So for scarcity reasons, it's going to drive property prices up. Interest rates will affect that for a while. But as a rule, none of us can really see rural land in Australia getting any cheaper. And the capital gains tax implications are based on the market value of the property at the time. So you're exactly right. If you might incur a capital gain tax liability now, it's going to be more in the future. And there's nothing to say that the family will be in more of a cash flush position to pay it then. Sometimes making the plan and not executing it can cost you more in the long run.
Absolutely. And as I said, that breakdown of family relationships, because that's the big thing, is you do this right. It might cost you a little bit of money, but what's the cost of what we call the intangible, the things that money can't buy? And I personally have seen through bad planning over the years, and not because people were ignorant or did it deliberately, it's just they didn't get the right advice from the right people, or they didn't want to deal with that problem now, has cost them a fortune down the track in family relationships, etc. So look, that's been amazing, Tim. We're out of time now, mate, but I am a little sad to do this follow-up podcast because I was hoping last year when we talked about this, because I foresaw something like this happening, I was thinking, maybe we're wrong. Maybe Tim and I are wrong. We won't have to come back and even address this again. And when I saw it pop up and I contacted you and said, hey, mate, you see what's going on in the UK? We're going to have another discussion. So I just want to say thanks for coming on, Tim. Like, you're a lawyer, so you're a succession, estate and tax lawyer as well. I know this is a little bit of your bread and butter and what you enjoy, but I really appreciate you coming on time. Now, mate, is there anything you want to leave people with and give us where people can find you online if they want to know more information?
Yeah, if you Google Tim Rivett, Rivett, lawyer, will come up. We're always happy to have a chat and see if we can help you with your circumstances. But I suppose my closing sort of statement to everyone is reiterating what we said in episode number 27, which is please don't do nothing. Don't do nothing about your succession. Don't do nothing if you hear something that you don't like, because the $3 million super tax thing is a perfect example. Australians did nothing for too long and actually allowed that to pass through the lower house. And it was only once the lobby groups actually got involved in between the lower house and the Senate that journalists started writing about it and lobby groups started getting some traction with the Teals and the independents. So just don't suffer in silence. Talk about it. Talk to AgForce, talk to your farming boards, talk to everyone about why this is concerning you, and don't let the UK example happen in Australia. Full stop. Totally agree.
It'll be our industry associations and bodies that put the political pressure on. So I'd say, share this episode with anyone you know that's in an organisation, like you said, AgForce, any of your industry bodies. I think that we need to start talking about this because it could sneak in very, very quickly. And if it's not got the label on it, inheritance or death duties, it could very easily slip under the radar. So look, Tim, thanks very much for your help, mate. I'm sure you've got a day full of legal superstar work to be done. So I'll let you get back to it. And mate, look forward to the next one.
Thanks, Ben. Thanks, everyone.
Well, isn't it interesting that 18 months ago, we looked at this and went, well, this could possibly happen in the future. And I get a sense that, this might happen. And then now we're actually seeing this being proposed and pushed in one of the Commonwealth countries, or a solid Western world country, the UK. I just can't believe that they're actually trying to push it through. And it's even reinforcing the fact that they could do it here in Australia. Now, I don't want to be a doom and gloomer or an alarmist, but I think it's really important. It's timely to actually suggest to everyone that we need to go back to our accountants and our appropriately qualified lawyers and say, what's the plan for the future? How could this look? What's the tax implications? Look at our succession. What do we need to be doing now to actually prepare our family, our business for this wealth transfer across the generations? I think getting a handle on what the implications are and what could potentially happen and processes we could put in place to be able to protect our family are really important. So Tim said, get to know your cost base of your farming assets is really important and kickstart that succession. But for me, I want to say it's get the right people around you. I just want to share with you one thing I hear really commonly from farming families when they're right at the point in a succession. Every single one of them, without exception, says, Ben, I wish we'd started this process 10 to 15 years earlier. Without a doubt, they all wish they had. So if you're 45 to 55 and succession isn't on your radar, you need to start thinking about preparing yourself, preparing the agribusiness, and preparing the next generation. I can tell you within those people that come to me right at the point in the succession when they're in their 60s or 70s is they say, we wish we'd started earlier. A small percentage of them say, we actually tried and we went to our accountant or lawyer or bank manager or whoever it might be, and we said, what do we need to do to prepare ourselves? And they were told, it's too early. There's no point starting now. You need to wait some time. That is absolutely wrong. You need to be starting early. My personal opinion is you need to start preparing for succession right back at the beginning. The day your children hit the ground, you need to be starting to educate them and preparing them to be able to take over the management of family wealth, or preparing them to be good custodians of not only the land, but the family wealth. That's the first stage. When they get out of school and they start going their own way in the world, you need to be really then going, okay, how do we start preparing them to be good custodians, even more pressure to be good custodians of the family wealth and good leaders of the family, and also how to build those communication skills to work well together. So look, that's it for today. I really enjoyed that conversation with Tim. I appreciate all his help. If you enjoyed the podcast, if you enjoyed this episode, make sure you share it with your family and friends. That allows us to get more information out to the people that haven't heard about us. And also jump onto Apple Podcasts and Spotify if you can, and give us a 5-star rating if you're enjoying it. That makes a huge difference to the number of people that get to hear the podcast. Well, that's it for me today. I'll see you for the next episode.